This is the time of year where I start fielding a lot of questions from clients, from family, from friends, potential clients around the current state of the markets, where I think markets are going, and whether or not it's a good time to be investing. So in today's episode, I'm going to be talking about the current market environment and how you should be thinking about your investments from a short-term, mid-term, long-term perspective. I'm going to be providing you with some insights and some data to help you make better decisions when it comes to your own investments and specifically your retirement accounts. So given where we're at with the markets, we're coming off a really good year from the S&P 500 and various other Russell 2000, NASDAQ, Dow Jones, et cetera. We had a really good year in 2024. But given what we're starting with now in 2025, the upcoming presidential implementation, you may be asking yourself, is now a good time to invest? Typically what I see is many investors who ask this, they're typically assuming that the stock market's current level, it's going to offer some type of insight into its future direction. However, what the research shows is that stock returns are very, very unpredictable, and making decisions based on the market's current condition or recent performance, that's a form of what we call market timing, which is a huge no-no. And this approach can pose a lot of problems for investors. So for example, market timing requires you to make two correct decisions: when to exit the market and when to return. Consistently, we haven't seen an investment firm or an individual get this right. It's very, very difficult for somebody to time this properly. You could have all the best technology in the world, algorithms, the brightest minds on Wall Street, and yet still it's very difficult to get this done consistently. Warren Buffett had made a bet to Wall Street years ago around how holding his basic index fund would beat the actively managed hedge funds when it came to investment performance over a specific period of time. So market timing requires those two correct decisions: when to exit, when to return. Very difficult to determine whether when you're going to do that. Next is leaving the stock market for cash. That's going to lower your expected return as an investor. So if you think about it, if you get out of the market and you're going to put your money into a cash account or in a money market, you're potentially giving up a significant amount of returns. The best example could be in 2020, March 2020, when the S&P dropped more than almost 40 points because of the COVID pandemic. Shortly after that, 3 months later, we saw the market rebound. We had one of the most incredible bull markets of all time. And the people that went to cash, they missed out on that bull run. Then what we're looking at is average returns are similar following a new market high versus a 10% or greater market decline. I'm going to be whiteboarding this in a second. But I think what you'll see when you look at those average returns, they are going to be very, very similar. It might be contrary to what you're thinking about. Now, what we're also looking at too is research offers little evidence that market timing or other types of prediction work consistently. And so the stress of being out of the market can be just as great as the stress of being in the market. The stock market can unexpectedly deliver those large returns in a short window of time, and we just never know when it's going to happen. We have no idea. When you look at some of the all-time highs, looking at the last 100 years, they came at very sporadic times. They were spontaneous. So you have no clue when it's going to happen. So investors who leave the market, they're removing themselves from participating in the potential gains. This is comparable to leaving a seat at a sporting event just before a scoring play. So to catch the action, you got to stay in your seat. So great example there. And then another common reason for asking the question, is now a good time to invest, is FOMO, the fear of missing out. We live in a FOMO society. People are always, have the fear of missing out on something, whether it's Bitcoin or crypto or this coin or that coin or this investment, that stock, Nvidia. It just is what it is. But during a downturn, some investors think they can ease their stress by just leaving the market. Like, I don't got to worry about it. I'll just pull my money out. However, when we start seeing this rebound, when we see the bounce, which always happens, by the way, we just don't know when, they feel the stress of being out of the market and missing those early gains. So with market timing, investors are often trading one form of anxiety for another. So is now a good time to invest? Well, let's dig into a little bit of data here. So I'm going to share my screen and I'm going to walk you through S&P 500 from 1926 to 2023. And this data set that we're going to be using is we're going to be taking an average of the all-time highs. And if you were to invest during all-time highs, okay, and then also investing when the market dropped more than 10% at that time. So basically investing at the top of the market, the bottom of the market, and the top of the market. And what do these returns look like over this period of time? So over a 1-year period of time, a 3-year period of time, and a 5-year period of time. So we're going to look at both sides here. We're going to look at it for all-time highs and also when markets dropped lower than 10%. What could we expect on average? So when we look at year one, so if we left our money in year one, what we're seeing is that the returns did roughly 13.7% on average if you were to put money into the markets during an all-time high. During a downturn, we saw those returns drop on average just slightly to 11.4%. So not too bad, not too much of a big discrepancy there, but still a little bit higher if you invested at an all-time high. But again, that's only 1 year. Now, if we fast forward to 3 years, we see that average return coming to 10.6% if you invested at an all-time high, and then investing when the market was lower, on average 10.3. So now we're seeing the numbers become very, very similar. And this is where you start seeing the magic of the averages, and again, just investing consistently and having that discipline. So now when we look over 5 years, now we're seeing the average return investing at an all-time high being 10.2% over 5 years there, and then on the lower end, 9.6%. So as you can see here, investing for a long period of time, there's really not much evidence, not much of a tip in the scale, if you will, to determine whether it's better to be investing at all-time highs or to be investing when the market has a downturn. What you're going to see here is that you're going to have a decent experience no matter what. So again, regardless of current market conditions, the capital markets, they're going to offer a positive expected return every single day. The key is you just have to remain disciplined, because the market's going to reward discipline, and they're going to reward you if you stay over time. So it's much easier to figure out how you can be successful when you're investing in the markets consistently, and when you have a level head, so you're not getting too high on the high, too lows on the lows. You just have this even keel, and you know that, hey, no matter what happens in the long term, I know that I'm going to be in a good position to be successful with my investments. So hopefully that provides some insights into whether or not it's a good time to be investing or not. If you have any questions, feel free to drop them in the comments here. I'm also going to be dropping another episode here on the different investment styles that you can implement into your portfolio. So be on the lookout for that. Feel free to subscribe so you don't miss another video. Thanks a lot, and I'll see you on the next one.